3, 2, 1.
Alrighty.
Welcome to the show.
It is January 21st. Snow day, I think, twice this week, right? 3 times.
Yeah, we got a little snow where we're at. I don't know if you guys got snow where you did, but we got ourselves enough for the rest of the year. I'm done.
Today's probably the snowiest in the last couple of years.
Yeah, I think since like 2019, if I recall. Yeah, it hasn't snowed like this. I'm actually leaving here to go shovel
your snow.
Snovel the show.
Yeah. Well, we got a lot of good stuff this week.
Good.
It was a 4-day week, but it was pretty interesting. So let's just get into it. First, going to take a look. I think it was last summer, maybe the summer before. I don't even remember at this point, but I started sitting in on the monthly.
Yeah, we hadn't heard about that for a while. So.
Yeah. So the Federal Retirement Thrift Investment Board, I got back in contact with them to try to figure out if it's on their radar to basically get us a ticker symbol for the new iFund. And they talk about it in this article that we're going to kind of go over, but it's actually the minutes from the November, the November meeting. We'll get to that. It's kind of interesting. There's a lot of stuff in there, and I'll give you guys the link if you want to sit in on that board meeting. It's like the first half of it is open to the public, and then they kick the public off, and they have their meeting, whatever. And we'll take a look at a MarketWatch article that came out within the last day or two from I'm saying Perma-Bull. It's Tom Lee from Fundstrat. Pretty interesting. I'll give you the link also to that. It's actually on his it's pinned to his Twitter feed. It's a minute long, and it's definitely worth spending the 1 minute to see what he thinks is going to happen in the short run and the long run for 2024. And this thing called the January effect that is supposed to be, the S fund is supposed to be outperforming the C fund right now, and clearly it is not. And then the C fund chart. All right, so the Federal Retirement Thrift Investment Board minutes. So if you go to frtib.gov, it'll take you to this screen. Well, close to the screen. You can go to, you'll find the meeting minutes. It's pretty easy to find, pretty easy to navigate that site. They're always on, or generally on the fourth Tuesday of every month. You can sign up and get alerts, and you can look at all the historical board meetings in PDF format. So this last one, I'm just pulling some of the interesting kind of bullet points out of it. But so Mr. Courtney is the director of the Office of Participant Experience. I'm sure he had a rough time when they first rolled out this new TSP. But he reviewed the monthly participant activity report, reported that more participants are borrowing from their TSP accounts than a year ago, with a 25% increase in general purpose loans in September over the same month in 2022. So the initial uptick in new loans after Converge, which was the new TSP, once it went live, because participants can now take 2 general purpose loans. So that was fine. They kind of expected that. But the more recent increase is consistent with those of other 401k plans, suggesting economic conditions as the driver, meaning I'm sure most people have heard, credit cards are starting to get maxed out. Even though the economy seems to be running along smoothly, inflation is starting to take a toll, and people are starting to dip into their 401k and TSP for loans for day-to-day activities. Not good. Mr. McCaffrey is the Chief Investment Officer. He reviewed the monthly performance relative to benchmarks for TSP's investment managers. So a lot of people have asked, why does the C fund or SRI fund, any of the funds, they don't track exactly the indexes, okay? And it says on the TSP site that the goal is to track the index. It's their goal is to track the index. It's not exact to the index. So when we put up charts of the SPX or the SPY, the SPY is an ETF that is the same kind of idea of what the C fund is trying to do. It's trying to track the SPX, which is the actual index. So if it can be off a little bit, and people's
Yeah, and you can't buy the SPX. You have to buy the
you
SPY.
buy an ETF, the SPY,
Or you buy the C fund, right? I mean,
right,
that's how it works. So
right, and the I fund tends to be the one that's the most off sometimes. I mean, it's not off a lot, but I get questions quite a bit about why why isn't this and that, and why don't you guys do the I fund instead of the EFA? Well, I can pull up a chart of the EFA. I can't pull up a chart of the I fund. It only exists in the algorithm of TSP. So that's why we do it's the I fund is trying to track the Europe Asia Far East Index, and to buy that index, you would buy the EFA, which is what the I fund is trying to do also. So it's the same. It's the same, but it's not going to be to the penny. And when you add into that, they have both BlackRock and State Street. It used to be just BlackRock. Now it's State Street has a piece, and I think there's a third company that has a piece. And so when it all gets mixed together, it's off a little bit from the index. And the way they usually describe it in these meetings, and this, the minutes from the meetings, both BlackRock and State Street, FC and S funds performance match their performance of their respective indexes. BlackRock's and State Street's management of the I fund resulted in performance exceeding the international index. So the I fund actually beat the index by 92 basis points and 151 basis points respectively. So the amount that BlackRock was managing beat by 92 basis points, which is, I think, 0.092%. And State Street was, beat by 51 basis points. So, and they say primarily due to fair value pricing. I don't know what that is. I don't know what that means. But that's where sort of the error essentially comes from, right? And then this is kind of the big one. TSP investment option benchmark study. So Mr. McCaffrey, Chief Investment Officer, discusses the benchmark study that is conducted every few years to determine continued suitability of the benchmark indexes used by the TSP core investment funds. This year, the board engaged Aon Investments to conduct a study. And remember, this is the November minutes. Okay, so Aon is knowledgeable about the full range of widely available indices used by institutional investors. The board asked Aon to consider potential applicability of these indices to the TSP core funds and, if necessary, recommend a change. I think we all know where we're going here. Mr. McCaffrey then introduced representatives from Aon. Okay, so they do this benchmark review. Aon examines methodology of the indices, opportunities covered, as well as investability and liquidity. So they're talking about the I fund. I don't want to read all this stuff to you guys. Aon reviewed such trades and the potential impact. It also reviewed peer practices specifically related to the I fund. Finally, with any change in recommendation, Aon also reviewed the potential transaction costs to weigh the risk-return benefits of making such change. So the conclusion, by previewing Aon's recommendation, so Aon recommended no change to the C, S, and F funds. And obviously this is congressionally mandated, right? It doesn't talk about it in here, but we all know that they don't want government TSP money going to China. So this is the impetus for this whole thing. So for the I fund, Aon recommended a move from the Europe Asia Far East Index, which covers parts of the non-U.S. developed market, to an index that would additionally include small cap, Canada, and emerging markets. So they looked at 9 international indices, which were narrowed down to 5, of which Ms. Jalal discussed 4. Okay, so she states that each of these benchmarks better align with the Federal Employee Retirement System Act, which requires that the I fund have a reasonably complete market representation of the international equity market than the current index. So apparently they have found, how many years have we had the I fund? 20 years or whatever. Now they found that there are better indexes that we can use to meet the law. And so they highlighted the incremental exposure the TSP would obtain by adding stocks from Canada, emerging markets, and international small caps. So the recommendation, of course, is to change from the Europe Asia Far East Index to the all world. It doesn't say it there, but that's what this is. All world IMI ex-US means take out the UX, so it's the whole world minus the US market, minus the China market, minus the Hong Kong market. Okay. So Aon estimated the transaction cost to be $80 million to transfer TSP iFund from Europe Asia Far East Index to the All World ex-US ex-Hong Kong. $80 million to do that. Aon then compared the securities lending yield between the current index and recommended index and estimated that gained yield from securities lending be $30 million. So basically, the government should get its money back after, a couple of years. I think it's unbelievable. It's mind-boggling that we're making this transition, and nobody uses this index. It doesn't have a ticker symbol.
There isn't one for it. Yeah.
I mean, the index exists, right? MSCI built it, but
nobody else.
Nobody uses it. They could. They
well,
just
we're
don't.
Special.
Yeah, we're special.
We're special, and we get to use $80 million to fix the problem we didn't really have. Now, if it outperforms, the current iFund, I guess that's not a guess. I mean, that is a good thing. But that, the proof is going to be in the. But how do you prove it?
You'll prove it over time. You just do a relative chart of the iFund.
You're going to need the data. Like, there's no chart.
Right, there's no ticker symbol, right?
You're going to have to do the numbers. You're going to have to run the hard numbers, and most people aren't going to do that. No. And if they give us access to it, I don't know. I still hold out hope that there's enough of a reason to create a ticker symbol that somebody will do it. It's just that we're so far. We've never. I mean, I don't recall being around when they did this stuff before, paying attention. So we don't know how long it took. Obviously, with the, the C fund, that's something like that is not a big deal. But like with the original iFund, like was there an EFA? Probably already. Yep. So
the S fund wasn't really.
Yeah. So that's what I mean. Like, how long does it take them to go? Oh, somebody will put it together. Yeah. Hopefully. Yeah. Otherwise, it's going to suck because we won't be able to track the iFund.
Yeah, I mean. Yeah, you're right. You can't. I mean, so China has FXI is the ETF for basically China's S&P 500, and it's been tanking for the past 2 years probably. And so the new iFund would definitely outperform, the new iFund would definitely outperform the old iFund. Given that, but when China turns back around, it probably won't. And now that you're implementing this thing, if you included China, you would have gotten those gains. Then, if you did the all world index ex-US and left it alone, that ticker symbol already exists, and it will eventually outperform when China turns back around. But it's neither here nor there. So anyway, that's the update for that. And if and when I can get back up with a congressional affairs guy from the Thrift Investment Board, I'll see if I can get some follow-up on whether or not they're going to do a ticker symbol. And fortunately, in the minutes, they give you names of the guys that should. It shouldn't be the congressional affairs guy that's going to answer the question. It would actually be Mr. McCaffrey, Chief Investment Officer. So if I can find him, I'll ask him the question. Okay. So hopefully you guys are kind of tracking Tom Lee. They call him the Perma-Bull on Wall Street. He was 100% right last year when basically everybody else was wrong. And so I went back, I think we talked about this last week, the week before. I went back and looked at his forecast for the last several years, and he's really good. But he's pretty much always bullish. So when he says there's going to be, a 2 or 3% drawdown, that's like everybody's, red flags go off because he's always like the market always goes up, right?
Yeah. So if he's being bearish,
yeah,
even the slightest bit's a big deal.
It is. So this is where he's at, right? This is the it's pinned to his Twitter handle at Fundstrat, and it's like I said, it's only a minute long. So what he's saying is, this is from I think the 16th of December. So yeah, 16th of January. So it's really recent. It's this week. He's saying he's optimistic for the year. He thinks it's possible that we make a minor new high before the end of the month, and then we might have something like a 7% drawdown. 7% drawdown for him to say is a lot. It's pretty significant. But he thinks 2024 overall is going to be bullish, right? It's going to, by the end of the year, we're going to be going up. He just thinks there's better opportunities to get in at a better price kind of in the second half of the year. But definitely worth listening to that 1 minute little video he's got pinned to his Twitter. And so that's kind of the lead in to this Market Watch article that came out on Friday. So I got a couple of pieces I'm going to pull out of this. So one sector is camouflaging the market's recent deterioration. So since the beginning of the year, the market's been down. The S&P 500, if you only look at the C fund, if you only look at the S&P 500, we're up a little bit for the year. The S fund, I fund, F fund are all down. The equal weighted S&P is down. The C fund, once again, is being held up by tech, which is what this article is about. And it can only last so long. So early Friday, futures are positive. S&P once again flirting with a fresh record. Okay, such a tease. There have been fears that after 9 weeks of consecutive gains into the end of last year, the market was overbought and due for a notable correction. But the pullback has been mild and short-lived. As Keith Lerner, chief market strategist at Truist Advisory Securities Services says, the good news is the market has done a decent job of working off some of those extremes through a correction in time. Okay, you can either have a correction in time or a correction in price. And so the market has been basically going sideways, more or less, since the third week of December. And it's churning, right? And so it's correcting in time as opposed to correcting in price. So then it goes on. Mark Newton, okay, head technical strategist at Fundstrat. So he's Tom Lee's head technical strategist. Tom Lee, the Perma-Bull, owns the company, Fundstrat. Mark Newton works for him. He's the head of technical strategies. He thinks yields in the dollar will likely pull back in the short term after their strong gains and will provide an upward bias for stocks in the final days of trading in January. Okay, so the S&P 500 can look to breach technical resistance at 4,800. So there, and that looks like it's happening actually Friday afternoon. As we're doing this, it's the Friday afternoon, and we're probably going to get to new highs by the end of the day. And that's going to be the news for the weekend, for sure. If we close above 48.18, that'll be the news for the day. However, a closer look at Thursday's action shows the benchmark equity barometers bounce, mostly powered by big tech once again, particularly the chip sector after Taiwan Semiconductor gave an upbeat revenue forecast jump in Apple after an analyst upgrade. So Newton is worried. Okay, this worries Newton. He says, this is good that tech's done well with exchange-traded funds like IGV's software ETF climbing to new highs. Philadelphia Semiconductor Index is a big one to follow. It's semiconductors. But he notes that less than 30% of S&P 500 stocks are currently above their 20-day moving average. Less than 20, so the 20-day moving average, which we talk about all the time, less than 30% of the S&P 500 stocks are currently above their 20-day moving average. As many other sectors have floundered this week. So this is pretty interesting. This is the S&P 500 index. This is a whole bunch of the sectors within that make up the S&P. Okay. And some other things. So we said the equal weighted S&P, right, which means tech isn't unduly weighted. They're all weighted equally. It's in the red for the day, for the week, for the month. For 3 months, it's positive, obviously, and year to date, it's down 2.5%. Tech clearly in the green, right? That's what's driving the train. The index is in the green overall, but basically everything else in there is down for the week, and most of them are down for the month, and obviously year to date. So there's very little propping this market up right now. And that's what makes the head of the Perma-Bulls really nervous. So he goes on to say, technology's ability to camouflage the recent deterioration can only last so long. This divergence will need to be alleviated sooner than later to give some confidence that about the longevity of this bounce. That's because the trend of higher bond yields and thereby a stronger dollar will resume, and this should eventually be a bearish development for stocks given prior correlation tendencies. So it's going to be important to see another broad-based recovery effort to have faith in this rally continuing. In the very short run, S&P has roughly 100 points, which will be important to monitor over the next few trading days. So this article is pretty consistent with what Tom Lee said a couple days ago. He's looking for a minor new high and then a pretty decent pullback. So take it for what it's worth. Okay.
That's
January.
about as much of a crystal ball as you're going to get from us.
Yeah, I mean, to be honest, there's always so much stuff we can put in these shows. Some of the technical analysts that I really, really like are extremely bullish because, and actually this morning I woke up and 6 o'clock, basically everything rolls into my feed, right? So the first thing I saw was the administration is how many billion for student loans? They somehow worked around the Supreme Court, or they found a pot of money that they have access to, and so basically the bottom line for 2024 is they're going to do as much pushing money into the economy as possible.
Of course, I mean, we want to look like the administration's doing a great job,
right? Which isn't every administration does that. It's not a political statement, and that's why the fourth year of the presidential cycle tends to be up. Right?
Absolutely.
Especially when the incumbent is running and he's in there. So that's why this stuff works. And so if you are not in the market in 2024 in general, you're fighting an uphill battle. Like even though you got, wars in Ukraine and an expanding war in the Middle East and all that, still high inflation, unemployment stable, but everybody's expecting it to roll over. Like all these things are happening. But the bottom line is liquidity. And as long as the government keeps pumping money into the system, it keeps going, especially to the Magnificent Seven, because they're so overweighted.
Yep.
Every time you put money in your 401k, a giant percentage of that is going to the every time you put it in the C fund, which is the S&P 500, which obviously the S&P 500 is the biggest fund in the world, some big percentage of that is going to those 7 companies, and that's why they keep moving higher. Okay, which kind of leads me into the January effect. So what's supposed to happen in January from a seasonal perspective is small caps outperform large caps. And this chart is a little bit old, but it because it was back here in December. It's from Jeff Hirsch, who does Stock Traders Almanac. But if you go to his blog, that's the link to his blog. So the going back to 1979, this is where the S fund should outperform the C fund. Okay, so starting basically in the middle of December, the S fund should be outperforming the C fund. This is the Russell 2000 divided by the Russell 1000, which is small caps divided by large caps. So for us, it's the S fund divided by the C fund, and the S fund should be outperforming, but that is not happening. The C fund is way outperforming. So for us, this is a chart of our S fund divided by our C fund. Okay, it's the actual, it's the DWCPF, which is our S fund, and the SPY, which is our C fund. And this box is the same as this box. Okay, so here we are in the beginning of January. The S fund should be outperforming, and it should have been outperforming since the middle of December, right? But this is actually what's happening. Here's the middle of December. It did outperform for a little bit and then rolled way over. And actually, as of today, it's way down here because the C fund is going up and the S fund, I think, is pretty much flat for the day. So the seasonality is not working, at least in terms of the January effect. So it's interesting. And if you look at it one other way, this is a chart of our C fund on the top and the S fund on the bottom. So if you look at it, it looks like they pretty much move, together. But the C fund, and now I did this a couple of days ago, so now the C fund is up here, and the S fund is actually a little bit lower. So they're diverging in the wrong way. The S fund is supposed to be outperforming the C fund, and it's not happening. So the seasonal stuff is good, but price has to be the final arbitrator of how you make reallocation decisions. Okay. TSP C fund chart. So last week we looked at the McClellan oscillator. Not a whole lot has changed, actually. We had a pretty big move through the week, right? You can see we got as low as about 4,700, and we'll probably close the week up here at 4,800 somewhere. But even with that, you got buyers, the green line is declining this week. Sellers are also declining. So it's pretty much a wash in terms of the ADX line. But you got prices rising and RSI falling, right? And you got a deeper McClellan oscillator into the red. And it's pretty clear to see when the McClellan oscillator is red, you don't want to be in the C fund. And if you can get out right when it turns red, you're in good shape. And if you can get back in right when it turns green, you get the up moves. So you also have head fakes, right? You get plenty of little head fakes in here, which from our methodology is where we take small losses. But if you can be in when you're in the greens, right, this is where you're going to make gains in TSP. And if you can be out in the reds, it's where you're going to avoid losses. And so on a weekly basis right now, if you're just looking at price, everything looks good, but the technical indicators do not look so good. All right. If you guys like that kind of analysis and you want more in-depth daily charts, definitely sign up for the newsletter at growmytsp.com. The newsletter this weekend is going to be really good. We had a question on the forum, the members-only forum, about is there a fund that is the inverse of TLT? So TLT is long-term government bond index. There is an inverse to it. It's called the TBT, Tango Bravo Tango.
I was waiting for TBD to be determined.
Yeah. So the TBT is the inverse of it.
Throwback Thursday, Throwback Tuesday.
Yeah,
It's
yeah.
one of the things you can go there.
Yeah, you can go a lot of
So
places.
it's the inverse.
It's the inverse. So basically, when yield is going up,
And is it in the mutual
TBT
fund window?
goes up. TLT is. I don't know if TBT is in the mutual fund window.
Well,
but
we'll see you in the newsletter.
Yeah, I mean,
If you guys are subscribers, make sure you dig in there.
Yeah, there's going to be a lot about yield. 10-year yield,
very
TBT,
important.
TLT. Yeah, hugely important right now.
If you guys have questions, you can put them in the comment section where we find the video. If there's no comment section, always shoot us an email at support@growmytsp.com, and the support team will get it over to us. If you like videos, please share them with your friends. We appreciate it.
Absolutely.
And hope you guys, if you're someplace nice, we're jealous.
Yeah, jealous. We're going to go shovel some snow.
Yeah, if you're sitting in the snow, we feel your pain. All right, we'll talk to you guys next week.
Out of here.